I rise today to speak in support of the 21st Century Glass-Steagall Act. I am honored to join Senators McCain, Cantwell, and King in introducing this bill. Washington is a partisan place, and this Congress has its share of partisan bills, but we have all joined together because we all want a more stable economy that works not just for those at the top, but for everyone. 7 years ago, Wall Street's high...
Legislation like this can be confusing, so we've broken it down into 10 points with pictures of 80s child stars to break up the monotony. Number 10. It would not end too big to fail. Instead, it would rebuild the wall between commercial and investment banking. According to the Senate Permanent Subcommittee on Investigations report, Wall Street in the Financial Crisis, Anatomy of a Financial Collapse, the 1999 repeal of Glass-Steagall makes it more difficult for regulators to distinguish between activities intended to benefit customers versus the financial institutions themselves. The bill addresses big banks trying to get access to public sector insurance to bail themselves out. In 2004, the four biggest banks in the United States hired flotillas of attorneys to craft hidden language in immigration legislation proposed by Congressman Luis Gutierrez. The language would have made taxpayers carry the burden for the high-risk, non-doc, hard-to-originate mortgages they were taking directly into their portfolio, and then later reselling as collateralized debt obligations. To quote the bill, it removes explicit and implicit government guarantees for high-risk activities. Number 7. The 21st Century Glass-Steagall Act would reverse the merger of Citibank with Travelers by no longer allowing common ownership or control with any insurance company, securities entity, or swaps entity. Number 6. It would put limits on the terms business of banking. It would limit these terms to the following: receiving deposits, extension of credit, and exchange of coin and bullion. The 21st Century Glass-Steagall Act still allows banks to compete with new payment systems like PayPal and start payment systems such as flash pay transfers between checking accounts. Number 5 addresses the heart of the past financial crisis. The 21st Century Glass-Steagall Act prohibits the exchange of structured or synthetic products. Synthetic products are things like option spreads or the collateralized debt obligations, the bundled mortgages which caused the last financial crisis. Because the indices for these spread bets are synthetic, the invented risk is calculated on unknown rates of possible failure, and thus they are very prone to fraud. Number 4. The proposed legislation increases transparency for hedge funds and the type of risk they hedge against. Hedge funds will have to be more transparent when institutional investors put money in the funds. The proposed legislation also attempts to put a firewall between private equity funds and banks. Private equity firms are already limited to a 24.9% stake in banks, and the 21st Century Glass-Steagall Act seems to assert this is too much. One of the reasons for limited private equity stake in banks is in 2009, the FDIC agreed to reimburse a consortium of private equity funds for losses taken in their investment in the banking operations of failed mortgage lender IndyMac. The FDIC agreed to reimburse the buyers for 80% of their next $1.6 billion in losses and 95% of losses thereafter. Under the proposed legislation, there is increased transparency for federal regulatory bodies and orders for the Federal Reserve to increasingly act in the public interest versus the interests of banking conglomerates. During the Bush administration, the International Monetary Fund reduced the degree of political freedom for our Federal Reserve in the United States to 58.7%. Lastly, the proposed legislation prohibits foreign banks from becoming holding companies and providing a way for U.S. banks to skirt U.S. laws.